Good morning and welcome to U.S. Estate and Gift Tax 101. I'm being joined by Steve Flynn. Krista Rabideau was scheduled to join us, but unfortunately she can't be with us today. So Steve, one of my partners, Steve Flynn, is going to be joining us here and working with me on U.S. Estate and Gift Tax 101. Now, the focus of this session is principally on U.S. estate and gift tax issues for Canadians. And we'll talk more about what Canadians is later. But this is often a source of confusion to Canadians is what's estate and gift tax and how does it differ? Because Canada doesn't have an estate and gift tax. Sometimes in Canada, people talk about a death tax, and yeah, there are taxes associated with death. What's important to know the difference is that Canada taxes on death the unrealized appreciation of assets held by the decedent. The U.S. does not tax the unrealized appreciation. It taxes the net value. So that is, the value of the assets less any debts. So here's just a real simple way to identify that difference. If a Canadian dies with $100 million of cash in the bank, they have zero tax on their death because there's no unrealized appreciation associated with that asset. If an American, a U.S. citizen or U.S. domicile dies with $100 million in the bank, they would have potentially a $40 million tax because the tax is on the net value and there's $100 million in the bank. Now, as a practical matter, that wouldn't reflect very good tax planning. And it's one of the things that surprised many people is that, Canadians at least, is that not a lot of Americans actually pay U.S. estate and gift tax because you can plan your way around it. Now, it doesn't mean that you get to take your money with you on your death, but it does mean that various organizations, non-governmental organizations, charitable organizations, may receive substantial amounts in your death. And that's a way to manage the estate tax. As opposed to giving it to a government, you may give it to a charity of your choice. And there's a number of alternatives. It's not just charitable giving that applies there.
Well, Warren, I was going to just interject there. One of the things I was reading recently is the Wall Street Journal had commented that with all the different changes in U.S. estate tax, their estimate was something like 1,900 people had paid U.S. estate tax for the 2020 year, a far lower amount than, say, 20 years ago when it was more like 50,000 people that were paying estate tax. We'll go into a lot of the reasons why that change is there, but it is quite interesting how few people this might impact.
Yeah, that's right. It doesn't affect that large group of people. And even with varying amounts, the exemption, we'll talk about that shortly. There will be a time for questions. So please make a point of adding your questions. You can put that right onto the screen. We'll get those and we'll talk about them at the end of the session. We'll also at the end of the session send you a survey. We'd like your input on topics that would be of interest to you, ways that we can improve this, maybe issues of concern that you have. And if you'd like our assistance with, please feel free to reach out to us. We're going to cover several topics here. Now, each one of these topics could be a day-long course. They're all fairly detailed issues. We're compressed them into about less than 10 minutes each one. But we want to give you some basic tools. Many of you out there are financial planners, investment advisors, lawyers, accountants. We've got people in Canada. We've got people from the U.S. and other countries as well. And so there's a range of people, but the focus here will be on how U.S. estate and gift tax affects Canadians and things that Canadians should be aware of. So our first topic, we're going to talk about domicile. And domicile sounds a lot like residency, except it's important to note it's not. Domicile is the operative term to determine if someone's subject to U.S. estate and gift tax. If they're a U.S. domicile, they're subject to U.S. estate and gift tax. Now, I'll say just as a rule for everyone, and it'll go right through this session, is anyone who is a U.S. citizen despite the fact they may live in another country, is always subject to U.S. income tax, to U.S. estate tax, to U.S. gift tax, and generation skipping tax as well. And there may be some other tax we haven't covered in there. But so when we talk about domicile, we're talking about someone who's not a U.S. citizen. The fact that someone's domiciled in Canada and they're a U.S. citizen, still subject to U.S. tax. And the important thing here about domicile is that U.S. domiciles are subject to U.S. estate and gift tax and generation skipping tax on their worldwide estate. Now, generation skipping tax, we're not going to say much about it, but it taxes transfers to generations beyond the next generation. So it's a way to prevent people from transferring it to their great-great-grandchildren and defer taxes by doing that. And U.S. domiciles, U.S. citizens, they're subject to U.S. estate and gift tax on their worldwide estates. Conversely, non-U.S. domiciles who are not U.S. citizens, and I'm going to say this is our Canadian, there's a limited application of the U.S. transfer tax system. Now, what's important here is that we distinguish when someone's a domicile, when they're not, because that makes a critical difference in how they're taxed. So here's just a chart that compares residency and domicile. We said U.S. tax, income tax uses the concept of residency. And that's essentially what people commonly refer to as one of two tests. It's either the green card. If you're a green card holder, you're subject to U.S. income tax because you're a U.S. resident for tax purposes, regardless of where you live in the world. If you are in the U.S. for more than 182 days in a calendar year, you're also a U.S. tax resident, despite what claims other countries might have on that. And that's before you consider the treaty. Domicile, though, is it would apply for U.S. estate and gift tax purposes. So someone could be a domicile of the U.S. or a domicile of another country, but a tax resident in the U.S. In other words, they don't necessarily are consistent in that you could be a U.S. tax resident but not a domicile of the U.S. Tax residency, that's an objective measure. Green card, 183 days. Domicile, that's a subjective analysis, more like Canada's test of residency. And Canada's test of residency is a common law test. And basically it says you put a bunch of different factors into a bowl. Where's your spouse? Where's your house? Where's your kids? Where do you work? And you put them in a bowl, you mix them up, and you say, that person, it smells like they live there. Now, that's a very simplistic way of looking at it, but it's a subjective analysis. Of course, you can have multiple residents in the world. You can be taxable. You can have tax residency in more than one country at a time. That's a little bit unusual, but we see it fairly frequently. Whereas domicile, you can only be domiciled in one country. Intention is less important with residency because remember, it's an objective test. Do you have a green card? You have 183 days. Whether you intended to or otherwise, what you intended is not that important. Intention is more important with domicile, saying, why are you there? Are you a student that's in the U.S. for a temporary period of time while you finish a degree? Are you on an assignment there for a temporary period of time? You might not be a domicile. There's a fairly high certainty associated with tax residency, but not with respect to domicile. And the treaty does provide a tiebreaker test for residency, but it does not provide one for domicile. This is an important fact, and that's going to be relevant in terms of planning in this regard. So I'm going to flip this over to Steve, and he's going to talk about U.S. estate tax.
Sure. So before we leave that slide, though, if you can go back 1 second there, one of the questions I often get asked is about U.S. green card holders. And someone says, well, I'm not a U.S. citizen, but I have a green card. And what's my exposure to estate tax? And I would say to them, as a general answer, by itself, a U.S. green card is not going to subject you to estate tax and gift tax. However, you got to go back to those principles Warren just talked about of domicile, and that in the combination could subject someone to estate gift tax. Warren, do you have any other comments on green card holders? They're unique, certainly.
Well, what we find here in Canada, and this is less true today than it was before, but there's lots of people say, I had a green card, but it's expired. And the important thing to know in that respect is the green card has expired, but the status is not. As long as someone has a green card that they haven't either formally abandoned, that's by going to a port of entry and actually surrendering it, and they'll issue you something called an I-407, the immigration people will, or by having it judicially rescinded, which candidly I've never seen in my career. They are still U.S. tax residents and have all the obligations of as if they were resident in the U.S.
Thanks, Warren. No, I appreciate that. So we're going to talk a bit about estate tax, and this is a very hot topic. And when I talk to clients, and I talk to advisors and professionals in the community, and everyone's got a number. They say, oh, well, the estate tax exemptions, 11.7 million. Oh, I thought it was 23 million. I thought it was 3.5 million. There's all sorts of numbers going around, and they all have relevance. And I think the important thing is to understand, what does the law say now? And what could the law change, or what could happen in the future? So if you look at current law now, the Tax Cuts and Jobs Act, which was enacted in 2017, that redefined these exemptions and gave a significant increase to the amount of the lifetime exemption that an individual, a U.S. citizen, a U.S. domicile has for their worldwide estate. So current law in 2021 is that each U.S. citizen, each U.S. domicile has an $11.7 million lifetime exemption. So they can make gifts up to $11.7 million in a lifetime, be exempt from gift tax. We'll talk about that shortly. If they passed away in 2021, the first $11.7 million of their estate is exempt from U.S. federal estate taxes. People will say, well, I thought it was 23 or 24 million. Well, that could be true if it's a married couple and each one of them is a U.S. citizen or a U.S. domicile. They would each have an $11.7 million exemption. So to the extent that your worldwide estate or your wealth exceeds that, you could be subject to estate tax. And that estate tax starts at about 18% and can get as high as a marginal rate of 40%. And that 40% isn't on the unrealized gains, like we think of from a Canadian tax perspective. It's on the value of that estate. As Warren had suggested, it's a very significant tax. Under current law, if you're not a U.S. domicile, you have a much lower exemption. That exemption under law in the U.S. is the first $60,000 of your estate is exempt, and then everything over would be subject to state taxes ranging from 18% up to 40%. The Canada-U.S. tax treaty will give some further exemptions and will increase that amount. We'll talk about that shortly. What happens under proposals, though, is this could change significantly. And even under current law, this exemption's only in place until the end of 2025. And so on January 1, 2026, it resets. It goes back down to a level that is more of the lower levels we've seen historically, approximately $6 million per person. So it gets cut in half. And it really creates an opportunity to use this exemption now or run the risk of losing it forever. And that's why a lot of families are going through planning techniques now to set up trusts, to do gifting strategies, to do all sorts of different strategies and planning techniques to use this exemption before it expires. Because if it's not used now, it goes away. And so, for example, if someone only wants to give away a portion of their lifetime of their estate right now, or a portion of their net worth now, if they're not using up to the $11.7 million, that partial gift is going to impact their future exemption. It doesn't impact what they've got now. And so it's important to make sure if you want to use it, this is the time to use it. I'll put some further urgency on it. In mid-September in the U.S., the House Ways and Means Committee, the Democrats have proposed a number of changes to estate tax, including a reduction of that estate limit from $11.7 million all the way down to about $5.9 million, effective as soon as January 1st, 2022. So that's a significant short cutoff, if you will, of this lifetime exemption. It's still being debated in Congress whether it gets passed or not. It's unknown at this point. But for a lot of families, if you've got this intention to make use of it, this is the time to start thinking about it and trying to start executing the things. The other thing that's important to remember with the lifetime exemption is it does change for inflation. And inflation is another hot topic people have been talking about over the last year or so. And so every year, regardless of whatever the exemption amount is, it increases for inflation. So it's important to put that in frame and put it in context of, individual that whatever happens in the future, and it's likely that lifetime exemption is going to be reset down to about $6 million. $6 million for a 50-year-old U.S. citizen, U.S. domicile, could be as high as $9 million when they turn 80 in 30 years. And so you just got to put that into context as to what that really means for clients. Next slide.
Steve, just one comment on this, the $60,000, the exemption. When that came to law, that was in 1986. That was part of the Reagan Tax Act. And everybody thought it was just an error, that it should have been 600,000, but it wasn't. So that's almost worth. Well, it's not worth a lot. So it's a pretty low bar.
Absolutely. So for non-U.S. domiciles or non-doms, what's included in estate tax? We weren't talking before about domiciles having their worldwide estate included, and that's every asset you have. For non-U.S. domiciles, they could be still subject to U.S. federal estate tax if they have certain U.S. assets. And so U.S. situs assets in general would include interests in real property. And that could be a commercial building, that could be a vacation property, that could be a timeshare you have, that would be considered U.S. real property. I was reading over the last couple of days on a case that was for a family in New York City that had a co-op apartment that although you had shares in a U.S. corporation as opposed to an interest directly in the real estate, the fact that you had shares in a U.S. corporation, even though you were non-domicile, that would still be considered to be a U.S. situs asset. So they were subject to estate tax on a co-op. Securities held by U.S. persons. So if you've got securities that are U.S.-based securities, shares in Apple or Tesla or any kind of U.S. company, those would be included in your estate. And this really impacts Canadians who have both stocks in U.S. Equities, but also they'll have those positions in their registered retirement savings plan. And the conclusion in the U.S. Rules on that have basically stated that if in your registered retirement savings plan, if you've got a direct interest in U.S. equities, those are subject to U.S. federal estate tax if you pass away holding them, even though they may not be subject to income tax because the Canada-U.S. treaty generally protects that from income tax until such time as you take money out. And so there's a different answer if you got a direct interest in U.S. equities in your RSP. In contrast, if your RSP owns Canadian mutual funds or any kind of non-U.S. mutual fund that itself has a direct interest or has an interest in U.S. equities, the U.S. has ruled that that is not a U.S. situs asset and would not be subject to U.S. federal estate tax. And so the RSP itself does not act as a blocker to U.S. federal estate tax. However, holding shares in a Canadian mutual fund considered a corporation for U.S. purposes would be considered a blocker. Other assets included as U.S. situs assets would include any kind of personal property you have in the U.S. So this could be artwork, jewelry, even items you leave in a safe deposit box in a U.S. bank. Those would be considered personal property and subject to U.S. situs assets, a U.S. federal estate tax. What it doesn't include would be any kind of property you own outside of the United States. So real estate you own in Canada, if you've got Canadian stocks, those would not be included. Most debt that you might have that's connected to the United States would not be considered a U.S. situs asset. So that would include a mortgage on U.S. real property. And so while there's a connection to U.S. property, the fact that a typical mortgage doesn't involve a direct interest or ownership of the land, that's what effectively excludes it from being a U.S. situs asset. And initially enough, most bank accounts, so bank deposits in U.S. banks or even U.S. branches of foreign banks would also be excluded from U.S. estate tax. I want to turn it over to Warren now. He's going to talk about gift taxes.
Well, gift tax is a funny thing because I don't think Canadians normally think about there being such a thing as a gift tax. Canada has an income tax that applies when people make gifts that have unrealized appreciation associated. They give shares that are worth $100 a share, but they were bought for $90 a share. The tax element is the $10. In the U.S., the entire amount of gift, subject to certain exemptions that we'll talk about shortly here, would be subject to U.S. gift tax. The important thing to note is that it only applies to tangible property located in the U.S. So not intangible property. In other words, it applies to gifts of U.S. real property. That's subject to U.S. gift tax. It's personal property located in the U.S., cars, art, jewelry. Cash is tangible property in the U.S. So if a Canadian makes a gift to another Canadian of $100, there's no gift tax associated, and there's no income tax associated with that either. But where a Canadian or any other person makes a gift of cash and it's completed in the U.S., it may be subject to U.S. gift tax. So this becomes a really important issue. I'm thinking particularly of parents that have children in the U.S. or their kids are going to school in the U.S. or things like that. Those gifts of cash could end up being subject to U.S. gift tax. Important thing to note.
Not to steal your thunder, Warren, but how might you prevent that from applying?
Well, the real way to do this is complete the gift outside the United States. And the simplest way to do it, and certainly when we're talking about larger amounts of money, I'd say is if that child in the US has a bank account in Canada, and if they don't, and you're to make large gifts, that's a really good thing to do, is deposit the cash to their bank account in Canada. They can wire transfer it out to themselves in the US the next day. So that's a simple way but avoid completing the gift in the US. Have your child come to Canada and visit grandma and grandpa north of the border, and that's where you give them the check. Those are ways that you can deal with that. Since it only applies to tangible property, it excludes intangible property like securities. So if I gift shares of General Motors, I'm not subject to gift tax. If I gift shares of, Suncor, a Canadian public company, not subject to U.S. gift tax. Patents, other intangible assets are not subject to gift tax. So it only applies to tangible property located in the U.S. Now, there is an exemption here that says to be a taxable gift, it has to be over $15,000. These are all U.S. dollars per recipient annually. In other words, this is not one gift of $15,000, but you can make 5 gifts of $3,000. But once you get over that $15,000 mark, it becomes a taxable gift. It excludes medical and educational expenses, but only when the gift is made directly to the medical provider or education institution. In other words, don't give your money to the kids and say, you pay the school. The payment should go directly to, the University of Pennsylvania or Harvard or, UCLA, or directly to the medical provider, not a gift to the individual to then pay it to them. We mentioned about avoiding U.S. gift tax. And the first thing to do there is to complete the gift outside the U.S. That's the easy way to do that. Going down with a check or a payment is a problem. Secondly, don't make gifts to buy U.S. real property. And the whole idea of gifting U.S. real property is pretty much a disaster. There is no exemption under the Canada-U.S. tax treaty associated with gift tax. So any gift of U.S. real property is going to be subject to U.S. gift tax where the value of the property exceeds $15,000. Now, there probably are circumstances where U.S. real property may be less than $15,000, but that's a pretty low bar. And that includes a gift to a child that says, or to a friend or whoever it is. The gift doesn't have to be to a family member. It's any gift other than to, for example, a charitable organization. So if you say, here's $100,000, I want you to buy this property for you, that's actually a gift of U.S. real property because the gift is conditioned on the purchase of that U.S. real property. Now, what you do to avoid that is instead say, here's $100,000, you do whatever you want with it. And maybe in the following year say, here's some really interesting real property in the U.S. that you might want to buy. But don't make the gift and immediately have the recipient buy the property. Yeah, you're asking for trouble on that one. Now, as long as the recipient is free to do whatever they want, that's a good start. But separate the gift from the acquisition of the property. The other thing is people often use trusts to acquire U.S. real property. In Canada, I probably deal with this more than I'd like to, because Canadians have come to the conclusion that trusts are effective ways to avoid U.S. estate tax. And that's true, but everything is about the implementation. So if you set up a trust to acquire U.S. real property and it identifies in there a beneficiary, that's a gift of U.S. real property. So if you're going to use a trust and you want to avoid having it treated as a gift, what you really want to do is put the money into the trust, and then a year or two later, you go out and find a property and the trust ends up buying the property. And yes, that recipient or the beneficiary receives an interest in the property, but the trust was set up well before that. If there was a gift that occurred, it occurred in a preceding year, ideally at least 12 months in advance. So,
and I know you're gonna talk about this more later on about vacation property, but that's often, one of the issues we'll run into is people want to buy a property and they've seen it, they've identified it, they've got 30 days to close. It's a competitive market in a lot of places, and so they don't have a year to close. But we haven't done any of those steps yet. We haven't got the trust set up. We haven't even drafted anything, and so that becomes a really difficult vehicle to use.
Gifting U.S. real property is almost always a disaster. And the only reason that I say almost is because maybe there's a reason to do it at some point in time. I can't think of a good one. And in most cases, I'd say really what you want to do is if you want to transfer real property to a child, what you really want to do is sell it to them. Give them $100,000 in 2020. And they buy the property from you in 2022. But there shouldn't be a requirement they use the monies they gifted to you that they have to buy the property. So you've got to separate those two events. And that's important. So we're going to switch here to talking about the Canada-U.S. tax treaty. We've talked about the problems. Now we're going to talk more about what ways the treaty helps you with those problems. And a spoiler alert, it doesn't help as much as you'd like it to. So, Steve, I'll let you go from here.
Sure, absolutely. Thank you. And I think just to restate what I think we've really emphasized the last 5-7 minutes here is the Canada-U.S. tax treaty has a number of provisions that can help on estate tax. It does not give you any protection from gift tax. So a lot of people that think about the treaty saying, well, it's to prevent double taxation, and I'll just use the treaty. As Warren stated, and I'll reemphasize, gifting U.S. real property has no protection there. And you can run into the situation where you've got gift tax that applies. You cannot claim it as a foreign tax credit in Canada. If you make a gift of U.S. real property, as a Canadian, you're going to, especially if you're gifting it to a family member, you're going to be subject to Canadian tax, income tax on any appreciation of gains. Your recipient, the family member who gets the property, isn't going to get any increase of cost basis. You get about 3 levels of taxation And you can have taxation that could be 100% of the appreciation of the property. So, this is a non-starter. It's a disaster, to use Warren's words. Solutions, as Warren suggested, you sell it, you hang on to it until you pass away. There's a lot of solutions there for that property. And it's become an issue for a lot of Canadian families because they've had property in the U.S. for a long time. They're not willing to travel anymore to the U.S. They kind of look and say, well, as they get older, maybe the family wants to use it. And so there's better solutions than that. The Canada-U.S. treaty does provide protection for estate tax purposes. It's somewhat limited to the extent that for a non-domicile, that protection is, let me back up, for a U.S. citizen, when they pass away, if they're subject to estate tax, whether they're a U.S. citizen or a non-domicile, that estate tax can be claimed as a foreign tax credit in Canada. And what it does is it gives us a little bit of a framework to say, well, how much is the estate tax? How much of a problem is it, in someone's circumstance? We recently did an exercise with a client who had, I'm going to say, about 45 homes in the Western United States. They're rental properties. It's about an $11 million portfolio of real estate, high net worth family individual. And when we were modeling this out and saying, well, in general terms, you've got an estate tax exposure of $4 million, roughly the net worth of the properties times the rates given the exemptions. However, it's not really a $4 million problem because if you died tomorrow, some portion that could be claimed as a foreign tax credit in Canada. And it's not like it's zero. What happens is you go through the Canadian rules, and whatever the capital gain is, if you were to pass away on those properties, because that'll be considered non-Canadian source gains, you can claim a foreign tax credit to reduce the Canadian tax that's taxable on those U.S. properties. You can't use the U.S. estate tax as a foreign tax credit against any Canadian source income or gains. It's only focused on those properties. And so when we did the mathematics of it and did the calculation, the $4 million of the $4 million estate tax liability, the individual could use about $1.8 million as a foreign tax credit against their Canadian liability. So the real exposure, if you're not patriotic as to what country you pay your tax to, was really about $2.2 million. Still something you wanted to do something about, still something you want to plan and strategize. However, the exposure was about half of what we really expected when you looked at the provisions between the two countries.
Steve, one of the issues here with the foreign tax credit, this almost makes it sound like it's an even split here. Any tax I pay in the U.S., I get a credit in Canada. And this is a good news provision, but typically the U.S. estate tax totally swamps the Canadian tax. And so, if you go back to my example at the very beginning, that $100 million, if I had $100 million in the bank and I'm Canadian, or $100 million of U.S. securities, and I just bought them the day before I died, I'd have zero Canadian income tax, but I'd still have a $40 million U.S. estate tax liability. So even that credit doesn't take into account that the U.S. estate tax can be very substantial, whereas the Canadian income tax, nobody feels good about paying that, but it's typically a fraction of what the U.S. estate tax is.
And you're right. It's based on it's the drivers. It's the base of what's taxed. In Canada, you're typically taxed on the appreciation only, any kind of unrealized gains or anything in a pension plan. In the U.S., the estate tax is on the pure value, the gross value of the asset at tax rates of 40% that are even higher than some of the capital gains rates in Canada. So when you model these out, it's something, but it's never going to give you that full answer or that full comfort. So for non-U.S. domiciles, they're not going to get that $11.7 million exemption that U.S. citizens, U.S. domiciles receive. However, they're going to get more than the $60,000 that we talked about under domestic law, the one that Warren talked about that got passed in the middle of the 80s when Ronald Reagan was president. The non-U.S. domicile is going to get a proration of that exemption. And it's effectively a calculation that takes the total value of their U.S. situs assets. Remember, we talked about U.S. situs assets being U.S. real property, U.S. securities, U.S. personal property that's physically located in the U.S. You take that value over your total net worth of all of your assets worldwide. And whatever percentage that is, that's the percentage you get of the $11.7 million exemption. So often people will get a little bit confused to say, well, I'm not a U.S. domicile. I'm just a Canadian who bought some property in the U.S. I've heard rumors that now that I own property in the U.S., my worldwide estate is subject to U.S. estate tax. That's not true. However, your worldwide estate is involved in the calculation of how much of the estate tax you get. You're still only subject to U.S. estate tax on U.S. situs assets if you're a non-U.S. domicile. But that worldwide net worth comes into the calculation.
So
in addition,
Steve,
go ahead.
Sorry, go ahead.
Yeah, no, please.
Well, I'm just going to say the way the formula works, and we've simplified it here, it's actually a much more involved computation. But if your worldwide estate under current U.S. tax law is less than $11.7 million, you would not have a U.S. estate tax liability the way the formula works. But if it's over $11.7 million, your worldwide estate, you will have a U.S. estate tax liability, even where as long as your U.S. situs assets, and that's U.S. real property, U.S. securities, and other property in the U.S. exceeds $60,000. So someone could have a $10 million home in the U.S., but if they're under $11.7 million, their worldwide estate, they wouldn't owe any U.S. estate tax, where someone with $100,000 in U.S. securities would have a U.S. estate tax liability because their worldwide estate exceeds $11.7 million.
Right. Absolutely. And you can add to that, if they're married, their spouse gets an additional married deduction. So the family can look at $11.7 million times two, close to $23 million together. Next slide. We've talked quite a bit about this. This kind of shows the calculation of that prorated exemption, talks about the marital deduction. Just to make sure we're keeping on our time here, I'm going to turn this over to Warren, who's going to talk about Canadians with vacation property, U.S. vacation property.
So here's a couple examples, and this is probably the hottest issue that we deal with on a regular basis is Canadians with U.S. vacation property. And by that, we mean, of course, real property. I'm going to take out commercial property. That doesn't mean it's not subject to U.S. estate tax, but it'll have some different nuances associated with in terms of ownership. And I put a couple examples up on the screen here, and these actually illustrate the point I just made in Steve's presentation is if a Canadian owns U.S. vacation property worth $10 million, but the value of his estate at death is $11 million, his U.S. estate tax would be zero because the current exemption is $11.7 million on his worldwide estate. Conversely, someone who has U.S. vacation property, in example 2, of $1 million, but their worldwide estate at death is $20 million, they would have a U.S. estate tax of $400,000. And I had a little asterisk there just saying that that would, you should watch out saying, are there U.S. securities? Steve mentioned about assets held in an RRSP or even an RESP or tax-free savings account. Those all count for this purpose as potentially as U.S. situs assets if they're U.S. securities. So, like I say, vacation property is, Canadians with U.S. vacation property is a big issue. And I'll switch into a slide, which we could talk about for hours on this subject here, but I'll give you some of the highlights. And I'm going to use in brackets, quotation marks here, solutions. None of these are perfect answers. They really depend on the individuals. And we'll walk through these really quickly here. I've kind of divided them up into what I call non-entity solutions and entity solutions. And often these solutions are ones proposed by clients. You'll see that because I've got gift on the list here. We've already talked about saying gifts of U.S. real property are virtually always a disaster. So non-entity solutions, joint tenancy. Now, many people, in fact, majority of people in Canada and the U.S. Hold U.S. real property, particularly their home, as joint tenants. What's important to note for U.S. estate purposes, particularly with regards to non-U.S. domiciles, Canadians, is that joint tenancy does not apply for U.S. estate tax where only one spouse provided the funds associated with it. So if you've got one spouse that's worked their whole life and the other spouse has not worked, you buy a property, you can put it as joint tenants, but for U.S. estate tax purposes, it's all owned by the spouse who contributed the property. So joint tenancy does not solve the problem. Now, you could have both spouses contribute equally, and even that same situation I talked about, where one spouse had all the income, had all the assets, the other spouse did not. And the spouse with the assets makes a gift of those assets, says, here's $1 million, I love you. And, 2 years later, they go buy a home using in part those monies that were gifted to the spouse. And then they put it in joint tenancy names. As long as they contributed equally, and the gift was not for the purpose of buying the U.S. real property, they'll be joint tenants. Now, if you make a gift with the intention of using it to buy a U.S. real property, it's a gift of U.S. real property, and you're back in a gift tax. So that's not a solution. But when you use joint tenancy, remember what's going to happen is that even when both spouses have contributed equally, now the entire property on the death of the first to die is in the hands of the surviving spouse. And so you need to think about what are the implications from that. Maybe the worldwide estate of the surviving spouse is less than $11.7 million and less than the threshold that will be reduced to in 2026. Tenants in common. Now, this is a way of dividing up interests in a home. So you have two spouses or spouses. One spouse owns half, the other spouse owns half. They transfer the property on their death pursuant to their will. It's not, in other words, not by operation of law. And so they could transfer it to a child or a friend or a charitable organization. And that's another way of keeping the asset away from the spouse, the surviving spouse, which might end up subjecting it to U.S. estate tax. We've talked about gifts, and we've said gifts are problematic. So I think the only thing I could say about gifts is I'll give you that sign that says, don't do it. Lots of people say they're going to sell their interest in U.S. vacation property before they die. Now, that is great tax planning. I love that. Except they need to think they can control when they sell the property. They might not be able to control when they die. So, that's problematic by its nature. Life insurance. Life insurance is an interesting solution. You can insure yourself against the U.S. estate tax when you die, so it doesn't really cost your estate anything. I'm not a life insurance guy. I'm sure there's some people on our call who are more familiar with insurance products, but remember, life insurance is a financial product and real property is a real asset. And in any sort of inflationary environment, that's a problem because now the property that you bought for $100,000 is worth $1 million, but your life insurance only covers the $100,000. There may be circumstances where that's a practical answer. I'm not necessarily a big fan of it. Life estate is another one. That's a much more complex subject, having a life estate, and it has its own set of problems, including a serious income tax issue on the survivor transferring the property. I notice I'm missing one here that I should have had on this list is non-recourse debt. Non-recourse debt can be another means of reducing the value of your U.S. estate. Non-recourse debt, not that common in Canada, much more common in the U.S. It basically just means that the lender can only satisfy their debt with the property. They cannot go against the borrower, just the property. And non-recourse debt is not the world's worst solution. but it has a lot of problems where you start involving other people. And the question is there really a loan involved there? So
it can also be it's a bit of a diminishing idea too, because at time, if you've got, say, a non-recourse debt with a U.S. lender, you're going to be making principal payments on that. And after 20 or 25 years, as you get 20 or 25 years older, and the likelihood that you're going to be still owning that property and passing away owning it, your spread between the debt value and the value of the property is growing. So it's a diminishing solution.
Yeah, and I made the comment about whether these are solutions, but I've told you all the bad things that happen about it. Each one of these can help you with certain problems associated with the U.S. estate tax. But what's clear is there's not a silver bullet in any of them. And I would suggest there's not a silver bullet necessarily in any of the entity solutions. Generally, they come closer to the mark here, but they also have their own set of problems. Historically, Canada used to allow individuals to acquire U.S. real property through a Canadian corporation and not adversely tax them. That's no longer the case. So if you use a Canadian corporation, what it does solve for you is if you hold U.S. real property through a Canadian corporation, you will not be subject to U.S. estate tax if you're not a U.S. citizen or U.S. domicile. Great. The bad news, you have a really serious issue with a taxable benefit under Canadian tax law. So Canadian corporations have an issue with them. Now,
yeah, I think that's one of your big issues. The other one is maybe a little more minor, but as you hold the property, it grows in value. When you go to sell the property, the mechanics of how the capital gain is first taxed in the U.S. and then comes to the Canadian corporation. You try and claim a foreign tax credit. You get into this refundable dividend tax mechanism with our private company rules. Your overall capital gains rate is going to be higher than if you had some of the other solutions. And so those two things make Canadian corporations somewhat unattractive.
Yeah, but they may have a place. That's probably particularly true with property that's not used personally. Qualified domestic trust. This is a term under U.S. tax law. The good news here on the death of the first to die, using a qualified domestic trust defers the U.S. estate tax, but it doesn't eliminate the U.S. estate tax. And so it's really a deferral mechanism. It may be, in certain circumstances, the best answer, but it's not a complete answer either. Canadian trusts, this goes back to the subject we talked about earlier. A lot of people think these are silver bullets, but they're not. In other words, you know what happens? As an advisor, I get a call from my client. They say, hey, I'm in Phoenix right now. I'm at the airport. We just put together a deal. I'm going to buy this property. And they said, how should I buy it? I've heard that everybody uses trusts. I just have to say, you're too late. You can't use a trust now because you've identified the property. If you set up a trust, at least to the extent you have someone else as a beneficiary, that's a taxable gift. Now, if they set up a trust where they're the only beneficiary, that's going to be called a grantor trust for U.S. tax purposes and has no benefit. It's not going to protect them from U.S. estate tax. It will protect them from U.S. probate, but that's it. They have a U.S. estate tax exposure. So trusts are really problematic and require a lot of care associated with them and for planning in advance as well. Both these last two items are partnerships, and using a Canadian limited partnership can be an effective way of avoiding U.S. estate tax. The nice thing about limited partnerships is that it protects you from, it can be used to protect from U.S. estate tax, and it also gives you a very attractive income tax result too, that the other provisions don't generally. So big fan of limited partnerships. Using them alone rests on an old Supreme Court case, and there is clearly some concern about that case, whether it would stand up in courts today. And that brings us to the last one here, the check the box partnership. Now, check the box is one of those really catchy tax terms that basically says if you have a partnership and you literally check the box on an IRS form, it magically transforms for US tax purposes to a corporation, but only for US tax purposes. So it can be used in combination with the limited partnership. Remember, these are all solutions, but they each have problems and uniquenesses and really require attention. So I'm going to pass this over to Steve to talk about Canadians with US citizen spouses.
Thank you, Warren. So just in the interest of time here, and I've got a few minutes before we can have some time to ask questions, I want to cover three things here. Where we see a lot of clients that are kind of called split citizenship, where one spouse is a U.S. citizen, another spouse, the second spouse is not a U.S. citizen. They're both residents of Canada, and it has some unique planning opportunities and some unique pitfalls that we need to be aware of. One is the idea that two citizens married to each other, two U.S. citizens that are married, can transfer assets to each other without claiming with a kind of an unlimited marital deduction. However, that's not true if one of the spouses is not a U.S. citizen. In that case, on an annual basis, they can transfer value. They being the U.S. citizen can transfer up to about $160,000 a year. It's $159,000 on the slide. It changes for inflation every year. So they can transfer that to their non-citizen spouse without any gift tax, without having to file any tax forms, without having to use any of their lifetime exemptions. So that gives them an ability over time, if you did it over 10 or 20 years, to transfer a couple $1 million from their assets to their spouse, which is fine. However, if then that non-U.S. citizen spouse passes away first, and generally if you see in their wills that all their assets go to the U.S. citizen spouse, who's going to now be the second to pass away, we've just put all the assets back into the U.S. citizen's hands. So now what we would be looking at is, well, what kind of planning techniques can we do for that U.S. citizen spouse? And so if you go to the next slide, one of the things we try and do is either avoid that transfer or have that U.S. citizen form a trust either during their life or commonly in their will, so that in the will of the non-U.S. citizen spouse, so that the assets that are being transferred to the U.S. citizen can go into a trust. The idea is that U.S. citizen spouse can use the property during their life. They can encroach on the capital. However, they're not considered an owner of the assets in that trust for U.S. estate tax purposes, and therefore wouldn't be subject to U.S. estate tax on those assets when they pass away. So there's some planning techniques you can use in a situation when you've got a married couple where one of the spouses is a U.S. citizen.
Steve, can I emphasize for people that when we talk, a lot of people kind of conflate citizenship with residency. So the issue here, though, is clearly citizenship. If your spouse is not a U.S. citizen, a U.S. citizen cannot transfer unlimited amounts to them. That doesn't change whether they're living in the U.S., they're a U.S. domicile or not. It's citizenship here that's important. So that's an important fact here. If your spouse is not a U.S. citizen, there's limits on what transfers you can make that are not subject to gift tax or estate tax.
Absolutely. And then finally, for gifting planning, we talked about the $159,000 annual limit for a U.S. citizen to gift to their non-U.S. citizen spouse. U.S. citizens can also gift $15,000 a year to anyone with no gift tax, with no U.S. tax return reporting, with no need to use any of their lifetime annual gift tax exemption. And so one of the planning techniques that we've seen families employ is to make sure on an annual basis that they're making those $15,000 gifts to their family members or to whoever they're intending. So for example, for a U.S. citizen couple, both people are U.S. citizens, and let's just assume they've got 3 children, and let's assume their 3 children are all married, and between everyone, they've got 6 grandkids. So if I count the number of donees, I've got 3 kids, I've got 3 spouses, So I got 6 plus the 6 grandkids. I got 12 people that can each receive $15,000 from both spouses. So the U.S. citizen spouse can give 15. So the U.S. citizen give $15,000, their spouse can give $15,000. So when you add it up on an annual basis, that's $360,000 a year they can give away. May not sound like much, but if they do it over 15 years, they've given away $5.4 million, which, if they're a high net worth family, that would avoid estate taxes of about $2.16 million. So those little procedures can really add up to something over time. That's the end of our formal presentation, as I understand. I understand we'll have some questions here. And before we get into the questions, we're always looking for feedback from our attendees. How can we improve things? What topics would you like to hear in the future? And please take some time to complete the survey. We're going to plan to do more of these in the new year, and we'd love to hear from you.
So, Kathy, you've got some questions for us there, do you?
Yes, we have actually quite a few questions from everyone. It's been a very interesting topic, so there are quite a few that we'd like to answer. One question asks, what determines the residency of an estate for income tax purposes? When will or won't a U.S. citizen domiciled abroad have a foreign estate? Are treaty tiebreakers available to dual resident estates?
That sounds like a topic we can do next time.
Yeah, that's, here's just the simple answer here is typically estates are going to be resident where they're managed. Now, there's some exceptions to that rule, but if a U.S. citizen dies in Canada, typically the estate will be a resident of Canada, not an estate of the U.S. And conversely, where a Canadian dies in the U.S., when they die in their domicile in the U.S. and their estate is managed in the U.S., it's going to be a U.S. resident estate. So that's a simple answer. There's a separate set of rules for trusts. Trust is a much more confusing proposition in terms of where the residency of a trust is, but states are typically where the estate's being managed. Unfortunately, the Internal Revenue Code is very vague on this subject. So you have to look in a case law, and that becomes very fact specific.
And one part of the questions is, what does the income tax treaty help? And unlike individuals and unlike corporations, where the income tax treaty between Canada and the U.S. gives us some guidance and some tiebreakers, there is very little guidance for trusts and estates under the Canada-U.S. tax treaty. And you can often get into situations where an estate is resident in both countries.
Perfect. Thank you very much. Another question we have is, what happens to Canadian parents who own U.S. property and wish to gift the property to their Canadian children? Would that attract the gift tax?
I think we probably answered that a few times here, but gifting U.S. real property is subject to U.S. gift tax, and the dollars are significant. Well, there's an income tax in Canada, as Steve mentioned, under the treaty. There's no protection under the treaty, so they would have a U.S. gift tax and a Canadian income tax, and they would not offset each other. So you'd really end up in a double tax situation.
I think as a one-word answer to quote Warren, disaster.
And maybe we should just go back. We did provide a solution here. The solution is to have the children buy the property from the parent. Now you say, hey, I'd love to have my kids buy it from me, but they don't have the money to buy it. Well, one of the ways to do that is that they sign a note to the parents. And in other words, that, they buy it, it's $1 million property. They put $100,000 down and they sign a note for $900,000 to pay the rest. And there's some details there they need to go through to make sure the note is viable. And you say, well, they don't even have the $100,000. Well, in a case like that, you'd say, give them $100,000, and a couple of years later, then they put the money down as a down payment, but it has to be unrelated to the purchase of the property. The gift has to be unrelated to the purchase of the property.
I think what I like about that solution is you're doing the things that you always want to do in a cross-border environment. If you're going to trigger tax in one country, you got to trigger it in the other country so that you can use the credits to offset each other. They've got to be allowed, which they would with an income tax or capital gains tax, which they wouldn't for a U.S. gift tax. And at the same time, for both countries, you're increasing your cost basis to whatever it is at fair market value. So there's a lot of good things on a transaction like that where it really doesn't cost the family that much.
I just noticed the clock clicked over to 10 o'clock. We're going to actually take some more questions here. We appreciate you joining us. If you have to leave, feel free to do that. Do complete our survey. We really do appreciate your input on that. And we'll take some more questions here, though. So thank you again for joining us. Kathy, what's next?
Our next question is, with regard to U.S. estate taxes for Canadians who are non-U.S. domiciles and non-U.S. residents who seek investment exposure to U.S. securities, would it be more prudent from an estate planning perspective to hold mutual funds or ETFs that invest in U.S. securities instead of buying the U.S. securities directly?
So that's a solution that can work to avoid estate tax. I think one has to ask themselves, is that the right investment direction, is to hold mutual funds or exchange traded funds? If it is, then that's not a bad solution. If instead people say, well, there's enough money in here that I want to have direct exposure to U.S. equities, and I don't want to have to pay the annual trailer fees or anything else that I would be seen in a mutual fund or exchange fund, or they know kind of which 10 or 12 funds, equities they want to buy. One of the solutions could be to form a Canadian corporation and to hold those assets in a Canadian corporation. Because if you remember, as a non-U.S. domicile, if you own shares in a Canadian corporation, you pass away, that's not subject to U.S. federal estate tax, even though the assets within that corporation are U.S. situs assets. I'd suggest you that's a way to avoid estate tax. That has other complications from a Canadian income tax perspective. You've got to go through, the model to say, well, how much more income tax and capital gains tax am I going to pay by having it in a corporation versus holding it personally? It shouldn't be that significant because we've got an integrated concept in Canada where, in general terms, $1 of investment or income in $1 of investment or capital gains earned in a corporation is somewhat similar to it earned personally. But you've got to go through the model on that. You've got to figure out how that's going to work. You got to figure out if there's withholding taxes on dividends from U.S. companies. How does that kind of go its way through the chain? I talked to a client a couple of years ago about this, and he looked at me and said, well, what if I just sell the securities before I pass away? And I said, well, that's a solution. It goes back to what Warren had said is, well, we don't know when we're going to pass away sometimes, but much easier to sell U.S. securities within a couple of weeks versus selling a U.S. real property that might have a longer sale process and may have some personal feeling that the family might want to hang on with.
Okay, perfect. Another question we have is a U.S. citizen living in Canada only subject to U.S. estate tax on U.S. situs assets?
Steve, you want to take that?
I can. I think I heard the facts that it was a U.S. citizen. And if someone's a U.S. citizen, they are subject to U.S. federal estate tax on their worldwide assets. It doesn't matter that they live in Canada or anywhere in the world. As a U.S. citizen, they're a U.S. domicile. They're subject to U.S. federal estate tax. Oftentimes, individuals will say, well, I don't need to be a U.S. citizen anymore. I could renounce my citizenship and therefore avoid the estate tax. And while that's true, there's something called an expatriate tax or an exit tax and a whole bunch of other transfer taxes that can apply. That's probably a topic we should cover in 2022 because it's much more complicated than just to say, I'll give up my U.S. citizenship.
And just to emphasize Steve's point, I mean, not only are U.S. citizens subject to U.S. estate tax, but they're subject to U.S. gift tax on their worldwide assets, even if they make a gift outside the United States. So U.S. citizens cannot escape U.S. estate and gift tax, regardless of where they live in the world, regardless of who the gift is made to, or where the gift is held. That exception only applies to individuals who are not U.S. citizens and not U.S. domiciles. So a Canadian can make a gift to their child in Canada, put in a Canadian bank account. There's no U.S. gift tax consequences, but a U.S. citizen is always subject to U.S. estate tax.
Perfect. Another question we have is a Canadian citizen and resident who has no connection to the U.S. but owns $4 million in U.S. securities in non-registered account. Which taxes are they subject to at death?
Well,
yeah, you want me to try that? So
Sure.
Which taxes are they associated with? So in the context of estate taxes, because that's our topic today, that individual, by having $4 million of U.S. equities in a non-registered account, and even if it was a registered account for that matter, would be subject to U.S. federal estate tax if their net worth was higher than $11.7 million.
Well, and just to add on to that, I mean, not only are they subject to U.S. tax regime, but if their worldwide estate under current law is less than $11.7 million, they probably wouldn't have a U.S. estate tax liability. But as long as they have more than $60,000 of U.S. situs assets, their estate is going to have a U.S. estate tax filing obligation. And that has, in other words, they have to claim the benefits of the Canada-U.S. tax treaty to exempt themselves from U.S. estate tax.
And we see that from time to time where financial institutions and custodians will look at that situation that was just described there and say, well, we're not prepared to release the funds. We're not prepared to release the securities to the beneficiaries of the estate until we get a clearance certificate from the IRS, until you prove that the IRS has looked at this, that if there's no estate tax payable, that you've claimed that. And they'll hang on to that. And that could be a year-long process to go through, as Warren said, file that tax return, claim the benefits under the Canada-U.S. tax treaty, and then request the IRS to send a letter saying, we effectively grant a clearance certificate. There's no U.S. estate tax in that situation.
Kathy, do you have a couple more questions?
It looks like that's all for right now.
Okay, great. Well, again, thank you so much for joining us. If you have further questions and you want to ask us, feel free to do that. We can arrange a consultation, and appreciate the opportunity to talk to you about this. It's a complex area. It's not well understood, and there's some unique issues there for Canadians, including U.S. citizens resident in Canada. And we look forward to talking to you again. Thank you.
Well, thank you. And Krista, I know you're recovering and Rabs get better, and we'll have you on the next one for sure.
Thanks for covering, you too.